Hi, I'm Roger Conrad. I'm co-editor of MLP Profits with Elliott Gue. What I want to talk about today is our safety rating system. In other words, how we rate all the MLPs. We cover all the MLPs traded in the U.S. in our How They Rate table. Just added a new one that Elliott mentioned a couple of weeks ago, Chesapeake Midstream Partners. And we'd urge you to go check out what he wrote about that. The upcoming issue of MLP Profits does talk about the safety rating system. I just wanted to elaborate on that a little bit because we have gotten, again, a lot of questions about what we mean. What we look at pretty much in our system is something of the same thing that we look at with other coverage universes, and that is the security of the dividends. And all of our criteria really pretty much relate back to that. One of them is how much of their business is based on fee-based infrastructure in energy. These are the safest kinds of MLPs. This is the safest kind of MLP business. It's kind of a quasi-utility business because companies make their money whether economic times are good or bad, whether it's from renting pipeline space to a major oil company or using a processing center or storage space. It's a very, very steady business, generates very, very steady cash flows. And the more a company relies on that business, the higher it tends to rate. Payout ratio is another criteria. Again, we use distributable cash flow. Earnings per share is a completely worthless measurement of MLP profits. That's something really you want to keep in mind as you see the headlines for earnings season come out. And we're going to start seeing earnings for our favorite companies as well as the rest of the MLP universe coming out in the next 2 or 3 weeks. A lot of the headlines that you're going to see in the popular press, what you might see on CNBC initially will be probably just something to do with earnings per share, and in that case is meaningless. MLPs minimize earnings per share. Earnings per share are taxable. MLP structure allows them to minimize earnings per share. So therefore, as a measure of profitability, it's useless. What you want to use, again, distributable cash flow, which is basically cash flow less any kind of one-time items that might pump it up or take it down, and then also taking out maintenance capital expenditures which are needed to run a company's system. So you take that out, you've got what a company can distribute of its cash flow to investors, and most companies tend to be fairly generous. So that's the payout ratio to look at, and again, we have that information. We will as each company announces its third quarter earnings. We are expecting some pretty positive numbers in the third quarter. For one thing, a number of companies successfully completed major projects. We've seen some mergers come off with some great cost-cutting opportunities there. And also interest rates have been so low. Corporate borrowing rates have been so low that many of these companies have been able to raise capital at the cheapest rates on the debt market as well as the equity market, because we've seen a lot of these MLPs go to new highs at the lowest rates ever, which means that they can go in and adopt a project that can be very, very low risk and maybe in an ordinary environment wouldn't be worth pursuing because of a low return, and suddenly it becomes extremely profitable and extremely low risk. This is the kind of thing they're enjoying now, so we're expecting some good numbers, we're expecting some good dividend growth, but the payout ratio is one way we'll be gauging that. Certainly dividend growth is important, but it is often a function, again, of the payout ratio. Fee-based businesses, we can tolerate a higher payout ratio than non-fee-based businesses, companies that, say, produce energy. We have a number of those. We like them. And so therefore, fee-based businesses that we have in the conservative holdings tend to rate higher on dividend safety. But again, you might notice the aggressive holdings may have a little bit higher yield. They can also generate some more growth for us because they are tied to energy prices. They're more tied to economic trends. And so therefore, the ideal portfolio probably mixes and matches some. The purpose of the safety rating system is not to exclude or to tell you to avoid low-rated companies. Rather, the low-rated companies are basically the ones that are going to have a little more volatility in the dividends, a little more volatility in the cash flow, a little more volatility in the share prices, whereas the fee-based companies are more steady and secure. So you mix and match. You balance things as befits what your interest is, and that's why we do have 3 portfolios: conservative, growth, and aggressive, to really make those distinctions so people can make intelligent choices. A couple other another aspect of our safety rating system Debt, certainly debt is another widely misunderstood criteria or figure regarding MLPs. Most MLPs, again, they're capital-intensive businesses, so they're going to borrow maybe a little more money than some expect. And if a rating service, and one very popular competitor of ours, in fact, has written a series of articles that questions the safety of some of the MLPs based on debt levels. And again, they're using the wrong metric. Basically, you don't compare debt levels to earnings per share, and you have to look at debt in terms of the MLP. I think one of the most useful measurements of debt is how much they have coming due. Cost of capital, certainly important. You can look at interest rates. But in any case, our MLPs are in pretty good shape regards their balance sheets. And in fact, after a year of being able to borrow at very low rates, those balance sheets are actually in better shape than ever. So these are criteria we're going to look at. We're going to be updating the safety ratings on all of our companies. Again, use this system as a way to making intelligent choices about what you might need in your portfolio. Someone who absolutely cannot tolerate volatility and can't tolerate the threat of a dividend cut is probably going to want to stick with the conservative holdings. On the other hand, someone who can tolerate a little risk and can certainly pursue those higher yields that are offered by companies like Regency or Lynn that we have in the portfolios, or EV Energy Partners, for example. So mix and match and use our information to best advantage. And we will be covering, again, the numbers on these companies as they appear in the next few weeks. Thanks for tuning in. I'll look forward to chatting with you next time.